Gautam Chhaocharia, head of India Small and Mid Cap Research with UBS, joins us live. Gautam, good morning and good to have you back. Gautam, the script of how Indian markets moved in the month of August was a function of rupee. What do you think could influence the script of how Indian markets will move in the month of September and henceforth?
Good morning. So I think the rupee script will still be the biggest one for the markets. And the way we look at it is that till 62, 63, the rupee move was more a symptom of the underlying stress in current account deficit, etc., and not necessarily creating damage on the real economy as such directly. But again, the recent move over last 2-3 weeks specifically, that has indicated rupee moving to levels where it itself can start causing damage to the economy and the markets, becoming a more vicious cycle. Higher rupee, higher inflation locally, and which also puts more depreciating pressure on the rupee longer term. So we are getting into a vicious cycle from the rupee front, and that's something which hopefully the government and the central bank can address by taking redeeming measures.
So what happens,
that will
Gautam,
be the
then?
biggest driver for the markets.
Right. What happens then in the near term? Do you think there is a chance that the Nifty may break below the previous low of 5250 as well, and we may head down to 4800 kind of levels? Or do you think this market is going to sort of linger in that range of 5250 on the downside and perhaps 5700 on the upside?
So we are still sticking to that view that 50 to 50 is a kind of lower end of the range, unless we see another leg down the rupee from current levels of 65. So if we see a bigger leg down on the rupee, then it itself can cause Nifty to move down. The important point here is timing, and when we say timing is also the fact that because the rupee has depreciated, we are clearly seeing signs of economic slowdown. That should at some stage lead to slowdown in trade deficit numbers and current account deficit numbers. We've already seen initial signs of that, but we need to see more clarity on that to get more comfortable on currency and therefore the economy. Now the timing is important because the real economy, in terms of adjusting to the higher levels of rupee, in terms of slowing trade deficit, that does take time. It can surprise markets positively, but still it will take time. While the currency market and stock markets are more real time and do react to a lot more short term sentiment as well as noise. That's a tricky part. So stabilizing this sentiment for the next couple of months, especially from the government side, that will hold key whether the market really cracks below 5250 levels or not.
Gautam, what are the kind of sound bites you're picking up from some of your global clients, global institutional clients? Of late, foreigners have been selling, and still India is a crowded trade, and foreigners are net long in India based on the kind of money they've invested in Indian equities this year. Do you think in the short term the technicals are still not favorable for us?
So technicals are not favorable in terms of a real big up move in the market, even if we see some stabilization in global equity markets. So yes, in that context, global investors we speak to, and I've met a lot of them over last 10 days also, they are broadly bearish in their mind, but not in terms of their positioning yet. So that is a kind of a technical overhang on the markets and performance on the way up. Now whether it is enough for them to act at these levels in terms of panic and despair, again that's a tricky one. I really haven't seen that kind of approach in terms of investors dumping Indian stocks at whatever levels. So because there are two reasons for that. One is they are not faced with redemption pressures, which this is very different from 08-09, when a lot of the global funds, equity funds, were facing huge redemption pressures. So they had to dump at whatever level. So the currency rate didn't matter, the equity levels didn't matter, they had to dump. There is no such pressure now. The markets have already corrected in rupee terms for the Nifty around 10%, and for a lot of the cyclical stocks more like 30%. Currency has already moved. So whether it makes sense to dump stocks when rupee is at 65 and Nifty around 53-5400, that's a call they're debating in their minds. So there's no dumping pressure because of redemption. Second fact is again, this is more relevant for GEM investors, less so for Asiax investors. In the GEM context, even now MSCI India in dollar terms since 2012 or since YTD is not necessarily the fourth quartile in terms of dollar returns. So they're still holding on, which basically means it's still not the ugliest around in terms of even real market performance. and there are countries which are more vulnerable and which is also showing up pressure points coming through. The last point from which we hear from a lot of investors is it's also not necessarily a call just about Indian economy or Indian markets weightage or underweight, overweight, but also a call in terms of the specific stocks or companies which they look at. So in their sense, they are being overweight India not just because of Indian economy, but also because of the specific companies which they can invest in. And that's the reason why we are seeing those 10-12 stocks continue to trade at reasonably premium valuations even now, because those companies do stand out not just in Indian context but also in the context of the overall gem markets.
Gautam, very quickly in 30 seconds, do you think today's weakness in rupee has got something to do with the food security bill?
Sentiment wise, yes, definitely. This has come at the wrong time. It's not a new news for the market, but when the market is looking for support from the government to stabilize sentiment, that does come at the wrong time.
The implications of food security bill for a market or for a macro watcher could be negative. But look at the flip side, and the flip side here is that the bottom end of the pyramid tends to gain. The bottom end of the pyramid will not be hit because of inflationary pressure, and their disposable income is not going to come under threat.
Yes, so that's how it works in the short term, but obviously there's a flip side to that argument also, which a lot of the experts point out, similar to Narega, is that in the short term it works well to take care of the bottom end, but it also takes away the potential to develop skill and long-term sustainable employment for the bottom end. So there are both sides of the argument. So there's social argument from the near-term point of view, there's long-term economic argument. So there's no real right answer there, frankly, from a political economic perspective. Having said that, for the fiscal part, and let's look at just the fiscal part. The critical thing also would be whether the government is able to rationalize other savings. So the government has been talking over the last few days that food security bill will lead to higher food subsidy in absolute terms, but on the other hand, they do expect savings from PDS efficiency and savings in other schemes. So they're still sticking to their subsidy targets. So the granularity in that aspect in terms of where the savings will come in, that will also hold key for the fiscal outlook.
Gautam, what is it that you're liking from, the sort of last legs of the market which are still going strong, the likes of IT as well as pharma?
So we prefer IT over pharma in the current environment, and the simple reason for that is both obviously benefit from currency, but IT services beyond currency, beyond US recovery, also can use this big move into possibly building a more robust business model also longer term, both in terms of ability to gain market share and possibly making their positioning much more competitive. So that's a serious competitive advantage which they can possibly build on. Now that's something which they have to execute. It's not something which can happen overnight, but that's a big call to be made for IT services. So the earnings surprise for IT services may last beyond 1 year if they're able to execute on that. Secondly, if you look at the relative valuation multiple now, it's still nowhere near the high seen earlier, and forget the tech boom of the late 90s, but even X that, the relative P multiple is still a long way to go. And that gives us a lot of comfort on that space, and to us it's not just a place to hide in the current market environment, but it's a pure alpha generating opportunity even from current levels.
Okay, Gautam, appreciate your time and thank you for joining us.